Inflation crisis explained quickly. Inflation has started to take a front row seat in the minds of many, but besides higher prices for food, fuel, and housing, how is it possible to explain to the general public exactly how dear the inflation situation is? This video will attempt to explain the predicament the Federal Reserve is actually in regards to inflation, which ultimately leaves the institution to choose between a deflationary depression that destroys the economy as we know it, or a hyperinflationary destruction of the US dollar, leading to complete system failure. Current United States federal government debt stands at over $30 trillion. However, even with the latest rounds of Federal Reserve interest rate hikes, a 10-year Treasury bond still only yields around 3% interest per year. To truly restrain inflation, like what was done in the 1980s by Paul Volcker, you need a real rate of return on Treasury bonds. To put it another way, Treasury bonds need to have a yield that is higher than the current rate of inflation to truly encourage people to save. The current rate of inflation is over 9%, while the 10-year Treasury yields only 3%. This means to truly even begin to start combating inflation, the Federal Reserve needs to hike interest rates by at least another 6%, and that is only if inflation does not continue to rise further than it already has. To put it simply, no one expects the Federal Reserve to actually increase interest rates to such a level that it could actually restrain inflation. As mentioned before, the debt of the federal government is over $30 trillion. Now, to keep the math simple, let's say the interest rate needed to contain the current inflation is 10%. The interest cost to maintain the $30 trillion and growing debt would be over $3 trillion annually. There's a problem with this amount of interest payment. It's almost as much as the government brings in taxes in any given year, which comes in at about $4 trillion. Here is a chart of how government spending is usually divided up in recent years. Notice the small gray slice with a 7% share. Now here's the same thing with a 10% interest rate taking up 75% of all tax dollars. Obviously, such a situation cannot come to pass. The federal budget cannot grow by $3 trillion to pay the interest, nor can the budget be cut enough in key areas like Social Security and defense to make such an allotment possible. The Fed will have to return to buying government debt through quantitative easing, and cutting interest rates. Debt is simply too high for interest rates to be used as a tool to combat inflation. For this reason, inflation will continue into the foreseeable future, and the value of the United States dollar will continue to drop against commodities, like food and fuel. Protecting yourself by owning hard assets outside of the banking system will be the only protection the average person will have against this rampant inflation. We hope you have found this video informative. Please like, subscribe, and share to get this information out to more people.